2 of the Outlook for 2022 with Martin Pring. I am your host, Bruce Fraser. In part 1 of the Outlook for 2022, Martin spent a tremendous amount of time on equities and the trends of inflation. It's an exceptional episode. If you have not seen it, watch it after you've seen this one. And here we're going to discuss bonds, commodities, the dollar, and gold. And Martin, thank you so much for doing this for the International Federation of Technical Analysis and also for StockCharts.com.
Well, thanks very much for inviting me, Bruce.
Gosh, it's such a joy. We've done this a number of years in succession. Every year is just a great event. So the floor is yours.
Okay, thanks very much. I'll just go through a quick summary of what I'm going to cover in this part of the presentation. That I think bonds stand a sporting chance of reversing their secular downtrend this cycle. And that's a big deal if it happens. Commodities have just triggered a secular buy signal as the primary trend starts to look a little bit iffy. We'll cover both those contradictory aspects later. The dollar index is just below very, very important resistance at a multi-decade secular downtrend line. And gold is extremely finely balanced technically on a long-term basis. And we'll take a look at that too. So let's first of all look at the US credit markets and take a look at the yield on 3-month commercial paper, money market yields. And you can see that the chart is highlighted in green and red. And that is according to our money market commodity momentum indicator model. When it's above 0, this indicator in the bottom here, that's when we get one of those green highlights that indicates the trend of money market rates is a higher one. When it crosses below 0, we get a red highlight indicating it's bearish. That indicator, by the way, is very simply constructed. It's just an 18-month rate of change of the 3-month commercial paper yield added to an 18-month rate of change for the CRB spot raw industrials, the commodity index. So there, right now, it just went above 0 a couple of months ago, and we're in the early stages of a rally. And notice that all the major rallies that have taken place since the 1930s have all participated with this indicator going into positive territory. So now we're going to look at the secular trend of bonds. And I can just put in these arrows which approximate the waves of the secular trend, both bullish and bearish. They typically last from 15 to 20 years. The current secular bear market started in September of 1981, ran so far until March of 2020. And that's an extraordinarily long time for a secular trend, whether up or down. So it's probably time we should be looking for a reversal. Now you'll notice there's some green and red highlights. Those are determined by the position of the indicators in the bottom window. The 9-month exponential versus the 96-month. When the 9-month, which is the red line, is above the blue line, which is the 96-month, that indicates the trend of yields is positive, and we get a green highlight. One of the amazing things about this system, or this approach, is that there are very few whipsaws. Here we're going in from 1860 to 2022, and we've only got 4 noticeable whipsaws that have taken place in that whole period. Nothing, in fact, since the 1950s, 70 years or so ago.
Martin,
yes, Bruce.
I was only going to say that, excuse my white coffee and mindset, but look at that incredible selling climax on yields here just recently into that big V bottom low there. Boy, if that isn't a classic climactic event to end a long-term secular downtrend, wow, that's impressive.
I'm glad you brought that up, because the next chart is going to show that in greater detail and why I believe it's very bullish as well. Before I do that, though, what I wanted to show you was that on several secular reversals, it doesn't happen. We don't go up and down or down and then straight up. We go into a trading range, and that's maybe what's going to happen in the current cycle. But let's take a look at that selling climax you were talking about, Bruce. So here's a 20-year yield. And underneath is a 12-month rate of change. You can see last year it moved. Oh, I should also point out here, first of all, that you can see that a bit of a trading range seems to be developing And you can see that the top of that trading range is gradually getting closer, or I should say the 96-month moving average is gradually getting, 8-year moving average is gradually getting closer to that breakout point. So that's an interesting thing. So what I was saying about the 12-month rate of change is that recently hit a record low and then swang into a record high. Now, I think a momentum indicators are nothing more or less than just a reflection of crowd psychology. And when you see anything like this, where you go from a record low reading to a record high reading, it indicates a dramatic change in psychology. To me, that's one piece of evidence that the secular trend is in the process of reversing. What I would be looking for is to see some kind of a trend line break as well. And we can draw a trend line in here for the 20-year Treasury yield. And we've got the Treasury yield in the bottom window as well. We could do the same thing in the bottom window. But you see in the bottom window, I like that much more if I want to be bullish, because the yield is much closer to the trend line. Any reason why that might be, Bruce?
Martin, what I see there is, because those are two really the same charts monthly, is the bottom one is an arithmetic scale. And that's typically the reason that you get differences in trend lines.
That's right. That's exactly right. I always prefer to use a ratio scale because I believe prices move in proportion and psychology seems to move in proportion. But I don't think you can ignore the fact that if that downtrend line on the arithmetic scale is broken, that will be one more piece of evidence that the secular trend is reversed. But I prefer to wait until the ratio chart also breaks as well before coming to that conclusion.
So a bit of advance warning from the arithmetic scale.
Yeah. So here's a 30-year bond that we're now looking at prices, and we can put in the secular uptrend for that. And if it breaks below 150 on the dollar USB, that would break that secular uptrend line. Also, it will break below this extended neckline of this potential head and shoulders. There's the shoulder, there's the head, there's the right shoulder. And that would, a month-end reading below 150 would also break that too. And that's one of the signals I'm looking for. Also, we've got the commodity bond ratio in the bottom panel here, which is kind of the, actually it's a KST, or a long-term smooth momentum of the actual ratio. And the ratio really is kind of like an ultimate deflation-inflation relationship, because bonds are deflationary, commodities obviously inflationary. And the idea is that when the KST starts to turn out from a low level, that gets you a buy signal, and you can see all these buy signals resulted in some kind of, were followed by some kind of a rally in the index. And you can also see that the KST is moderately oversold at this point, so maybe we're going to get a bounce. But I think it's very important to remember that the KST looks like it's oversold, but if you were taking the same distance on the upside, you could see that most situations, the indicator moves above this red line here, which is equivalent level of on the upside as where the momentum indicator is right now. And the reason, of course, this is showing higher readings is, of course, this is the secular trend is up. And usually when a secular trend is up, the magnitude and duration of moves in the direction of the secular trend. And so what looks like an oversold situation in a secular bull market could be somewhere around here in a secular bear market, in the sense of its oversold nature. So that's something worth bearing in mind. Next chart shows the basically the whole US bond market, the AGG, the aggregate bond fund. And underneath is an indicator called the special K, which you can plot on StockCharts. The special K is something that I devised that combines the short term, the intermediate trend, and the long-term momentum into one indicator. And about 70% of the time, as you can see here, it peaks and troughs with the security price that it's monitoring. And that happens about 70%, it's 100% on this chart, but it happens about 70% of the time. And so what we have to do here is to kind of figure out, it's easy to look back and say, well, there's the peak and there's the trough. So you got to find some kind of technique to help you through this. And one way is to draw trend lines on the special K, because it tends to be fairly volatile. And they may get a confirming trend line on the price itself to make sure that's confirming what the special K is doing. And that often indicates and gives you a good, reliable indication of a reversal in trend. We see the same thing on the downside here. Now we're looking at the price itself and recent activity, and you can see it's confined between two trend lines, or was confined between two trend lines, because this week we've seen a downside break, and that's consistent with what the special K is doing, because that's now just dropped below zero, and it's also already well below its signal line. So both those, that chart suggests that prices are going down and yields are going up. And so does this chart here. There's a 10-year yield, and underneath is a confidence ratio. That's the financials, the XLF, divided by 20-year treasuries, the TLT. And when it's rising, it means that investors are growing in confidence because they're bidding up the price of financials relative to treasuries. When it comes down, they're rushing to tap treasuries because they're nervous. And you can see that these two series move pretty closely together in a broad swing sense. And sometimes it's possible to construct a trend line for both of them. When the trend line's violated, we get a reliable signal of reversal in trend. You also notice that during here, you can't really draw many down trend lines, but you can see that the long-term oscillator here, the long-term KST, which monitors the primary trend, the short-term trend monitors trends 2 to 6 weeks or 9 weeks or so forth. So anyway, this was in a downtrend for quite some time, and both of them then turned into an uptrend. But now we're seeing the Financial-Treasury ratio begin to edge in above the green trend line here. And what just yesterday, which was the 5th of January, you see that the 10-year yield itself broke to the upside, with the ratio just edging through the upside and looking like it wants to go higher, because not only is the long-term momentum of the ratio up, but so is the short-term momentum as well. So all this stuff suggests that yields are headed higher. And that, of course, is a reverse head and shoulders. Now we're turning to commodities. And this is a secular trend for commodities. And I've put some arrows across the secular trends, or very long-term trends. And sometimes the secular bear, which is signified by the red arrow, turns out not to be a bear, but more of an extended 10-year or longer decade trading range. But you can see that there are distinct up and down moves that take place. And underneath is the oscillator that we looked at in part one, but this time the price oscillator is turned up the right way. So a rising oscillator is bullish for commodity prices, and a rising oscillator is signaled by crossing above its 48-month moving average. So we've seen 2, 4, 5 signals, and in December we saw a 6th positive signal being signaled. Now you may think that that's one of the things that we'll be looking at later on, is some of the primary trend indicators of commodities, and they're looking like things are overextended and commodities are coming down. So that might seem inconsistent that you're having a buy signal on the oscillator and on the long-term oscillator, and a sell signals on the primary. But if you look at these two blue lines just here that are coming into play now, you can see they occurred just after a couple of buy signals on a secular basis. But the commodity index did experience a sideways movement. So it's not inconsistent to get a long-term buy signal and a primary trend counter-cyclical sell signal. The one thing to bear in mind is if the primary trend or the secular trend is up, any bear market in commodity prices is likely to be very limited in scope.
Those blue sideways arrows represent a few years in time too. So
that's
even though
that's a great point, Bruce. Yeah, I mean, this chart goes back to 1850, so a little arrow like that's probably a couple of years.
So you get sort of a range bound condition in commodity prices for a few years before they start to heat up again.
Yeah, yeah, exactly. So that could well happen in the current situation. Here's a secular uptrend line going back to the 1930s. It's still intact. It's been violated a couple of times, and that was a giant whipsaw there. But as so often happens when you get a false downside move, a lot of people get very bearish on the break and have to reposition themselves on the bullish side afterwards, and that results in a strong rally. So we had another false break just here, and so far it's been a pretty strong rally. You can also see it's just gone green, indicating our commodity model is bullish as well. So now we're looking at the CRB Composite. Before it was a CRB Spot Raw Industrials. So this is a much broader indicator index that includes a lot of different agricultural commodities and so forth, that has a higher energy weighting as well. And underneath is the opposite of what we saw before. Before we saw the bond commodity ratio, KST. Now we're seeing the commodity bond ratio, KST. So when this is moving up, it means that commodities are outperforming bonds. And when it's moving down, it means that commodities are underperforming bonds. And I put these shaded areas in very quickly to show you what happens when the KST crosses below its moving average and then crosses above. We get one of these shaded areas, and you can see that commodities are in a negative trend throughout most of these shaded periods. Right now, it's in a bullish mode and it's overbought, but there's no sign of a reversal. But obviously, we're stretching the elastic pretty wide here, and it's probably not going to be very long before we see commodities retrace some ground. So here's the bullish side of the commodity, the secular side. It broke this downtrend line going back to 2011, and also broke above this previous high, which again reinforces the idea that we're in a secular bull market. And okay, we're overbought and may start to retrace some ground. But I doubt if we're going to retrace any more than the breakout point where there's now, which was resistance and is now support.
And that kind of makes sense with the Fed saying that they're going to, start to push against these higher trends of inflation, that they may actually have an effect for some period of time to check the upward trend.
Yeah,
their policies.
Yeah, absolutely. So this is an indicator I developed probably about 2 or 3 months ago or less. It's the ratio of lumber to corn, and lumber is a leading commodity because it's very interest sensitive because it's tied to the housing industry. So that makes it a leading indicator of commodities. And I've noticed that corn often peaks ahead of the CRB spot raw industrials. I don't have any reason to know. I don't have a reason why that is so, but it happens pretty consistently. So I thought, well, I'd take a ratio between corn and lumber, lumber and corn, create a KST from it, a long-term smooth momentum, and see where it led me. And what we find is that the peaks in this ratio often coincide with peaks in the CRB composite. Kind of fascinating that. And obviously we've just reached a peak here because that started to turn down again. So that's a negative factor going forwards. I should also point out it's a couple of dashed line arrows here, which indicate false signals, false negatives, because when they took place, the CRB composite rallied. So
that's fascinating, Martin, because you think about lumber as being sensitive to construction, housing construction, which is very much an early business cycle event, and maybe lumber is just an early cycle beneficiary as a commodity.
But why does corn lag? That's what I'd like to know.
Yeah.
I don't have a rational explanation for it, but it does consistently. So now we're looking at the Canadian dollar and the CRB composite. And you can see they move very closely together. Here's a big up wave from both series. There's a down wave. And if you look at the KST sell signals on the long-term sell signals, you can see that this is for the dollar. They also line up nicely with bear markets in commodities as well. Nothing's perfect, of course, when we get a series of false negatives in that period just there. But if you look now, you can see that the KST is rolling over, which doesn't look too good for the Canadian dollar or for commodity prices. And you can see that it broke out above this base here, and that breakout turned out to be a false breakout on the upside, another negative factor. But another thing I've observed is that the Canadian dollar has a tendency to lead commodity prices. So here you see the Canadian dollar peaking here and coming down, and commodity prices going up. The same thing here, the same thing here, the same thing here has been happening in the last few months. So none of this looks good, I don't think, for commodity prices at this point in time. It's not an actual sell signal, but it's a definite sign, given that relationship, that commodities may not be as strong as we think they are. So now we're looking at the CRB composite, and I've got a copper long-term KST to show you that when the KST is in a declining mode below its moving average, that tends to be bear. The KST for copper, that tends to be bearish for the whole commodity markets. And we see the same thing here. You've got a couple of gray areas because here the KST was coming down and the market was, the CRB composite was going up. Right now, of course, we've got a sell signal, almost about to go a sell signal for the copper. So let's take a closer look at copper. Here's copper in the top window, and underneath it's the special K indicator, which we talked about before. And I just wanted to show you a great example of how the copper and the KS and the special K bottom out simultaneously. And they also peak out simultaneously. It's quite remarkable how consistent and how cyclical the copper price is. Well, right now, the copper price or the special K is below its signal line, which is one reason why I think the special K is headed lower. Another is that it's also reached a pretty high level. So in order for it to go higher, we'd have to have a super bullish commodity market. And then I'm not ruling it out, but I'm just saying the probabilities are lower. That's going to happen, as you can see over here in that 2000 2008 period. So let's take a closer look at copper and the special K. Here's a series of trend lines to identify the reversal in the special K, and it's reversal in the copper price. And we get to the current situation where in the current cycle, we've already broken an uptrend line and moved, and the special K has moved below its signal line. But instead of going down, copper price went sideways. So the question now is it going to break to the upside or the downside of that trading range? And the special K has broken to the downside, but not decisively so at this point. So the suggestion, given the fact that this is at a very overbought kind of level, is kind of worrying. So I would just quickly go to the dollar. And here's the US dollar index going back to 1983, or the previous peak in 1983. The dollar is below resistance in the form of this extended trend line. It's also just below this downtrend line just here, and the KST is positive. So it's in a bull market above its 12-month moving average, but it's below resistance. So a pause in the advance of the dollar could well be in the cards here, even all as part of a bull market. And then also we have the special K for the dollar, which is also at resistance on this big downtrend line. And there is also, I said that the special K often peaks more or less simultaneously with the security it's monitoring. Here's an example where it didn't, because here's the high in the dollar index, and there's the high in the special K. So our final subject is the subject of the yellow metal, the gold price. And the first chart I'm going to show you is a very long-term chart. This is a quarterly chart. And underneath is a quarterly copper indicator. Now, for those of you who don't know what a copper indicator is, it compares a 14 period and adds it to an 11 period rate of change, and then smooths it with a 10-month weighted moving average. In this case, we're talking about quarters as opposed to months, which is usually the way the indicator is used. So the idea here is to take a look at the copper and see when it's above its moving average. And that moving average is an 8-quarter, 2-year moving average. So this green shaded period here tells you when the indicator is above its moving average. By the way, this is not the way that Mr. Koppel, the inventor of the indicator, intended it to be used. He used to use it on a monthly basis and just use buy signals. I kind of take it a step further and look for sell signals at the same time. So his way of doing it was to wait for the indicator to go below zero and then start to turn up, and that first turn up would signify a new bull market. And it's a really excellent indicator, which I thoroughly recommend you take a look at. Also, if you were watching the previous part of this part, second part on the special K, you can learn about the special K on StockCharts. Not only can you plot it on StockCharts, but there's also an article on it in the chart school. So anyway, here's a quarterly indicator in a positive mode here, and I can put in all the other positive modes, and you can see that it captures the majority of most of the moves and doesn't include a lot of bear markets and things. This indicator over here, this period over here, was not covered because there was not enough data to cover to calculate the indicator. So the idea is when you're in a bullish mode like that, that's a long-term bullish mode for gold when you're above your moving average here. And the same thing when the price agrees. And right now, of course, it's in a bullish mode because it's above the 12-quarter moving average. And the momentum is also in a positive mode as well. What recently took place in August of, I guess it was August of 2020, was that the price rallied back up to this very important trend line that goes all the way back to 1980. Remember, I should have made the point earlier that this is gold price adjusted for the CPI. So it's gold price in real terms. So if you think of gold as an inflation hedge, this is the indicator you want to watch, because a rising indicator means you're in an inflation, your inflation hedge is working, and a falling one means temporarily it's not. So it reached this very important trend line because it goes back all the way to 1980, which is what, 40 years, and it's been touched now 3 times. So it's very, very important resistance. If the gold price can go through that, it's going to be highly significant, in my view, from a very long-term perspective. But right now, it's fairly delicately balanced. And this chart shows you why. So we have now the pure gold price. You can see that whereas the CPI price was about the same as it was in 1980, the real price the actual price has gone up a lot higher than its 1980 peak. And underneath is an indicator I've been using in the first part of the presentation, which is a percentage price oscillator using that 6 and 15 exponential moving average, month exponential moving average. And the idea is that when it's above zero, in other words, when the 6-month is above the 15-month, above zero on the chart, that indicates a positive trend for gold. And I can put the others in, and you can see that it captures pretty well all of the major up moves. And with the exception of this signal here, where it peaked up a little bit and came down again, it makes a profit, avoids all of these major downdrafts that have taken place in the last 40 years or so, 43 years. The other thing is that you find with a lot of indicators, they give you some very good signals, but they also give you a lot of whipsaw or false signals. This indicator doesn't, for the gold price, is given 4 false signals as marked by these red arrows. And that's in 43 years, that's not a bad record. So right now, you can see that the indicator is right back towards its zero line. It wouldn't take much to push it through on the downside. On the other hand, it wouldn't take too much to push it to the upside. So I was saying that there's a very fine balance at this point because that PPO in the previous chart was very close to zero and therefore very close to giving us a reliable sell signal. So let's zero in on the daily charts and see if we can get a better feel for what's going on. Well, this is not the gold price, but the Spider Gold Trust, which trades pretty well the same way. And it's caught between 2 converging trend lines here. One on the bottom, just a little bit above 165, and one from the top, which is trading at around 170 or so. And underneath is our special K indicator. And that's in a downtrend, but it's actually starting to move up. And if you look at the short-term or daily KST in the bottom window, it started to turn up. So it looks to me like there could be a bit of a challenge going into that, into the new year, of that upper resistance level. And it's been very volatile the first few days of trading in 2022. So it's really very interesting to see how this turns out. So I would look for two benchmarks here to determine the direction of the next trend. One would be a break above 175. And if that happens, that would reinforce the bullish signal in a quarterly chart. And it would also help push that PPO away from that zero level, away from the danger of crossing below it. Alternatively, if it breaks below 165, say down to 163 or 162, that would suggest that gold is headed lower. And also, I should point out, if it does break above the upper green trend line, it's likely to break this special K downtrend line at the same time. So we're going to have to wait and see. Gold is extremely finely balanced at this point, and I wouldn't want to stick my neck out too much in either direction, although I lean slightly towards the bullish line, slightly towards the bullish side. What do you think, Bruce?
Well, the weakness that came in at the beginning of the year is in combination with the weakness in the stock market certainly shows that from a YCOP perspective, there's a lot of supply out there. And so it really is at a near a support level that it needs to hold. And so it really is on the cusp. It's right there, finely balanced in either direction. So it's I completely agree with the research that you've just shown us, and that you know, I think gold's got to commit itself one way or the other from here before we can, you know, really commit to it.
Yeah, and if it is a break to the upside, given all that resistance on that inflation-adjusted chart, all hell could break loose on the upside.
Yes.
But if it's a downside break, we need to respect that too.
Yeah, and so if we get a break of that green downtrending line there, we get a penetration of that to the upside, that'll certainly be very early in the move. And it certainly, I think, makes sense to be patient with this market right now, and just let it prove itself one way or the other.
Absolutely. Well, that completes what I have to say.
Well, Martin,
thanks for joining me, Bruce.
Oh my gosh, thank you so much. A big thank you to StockCharts.com, StockCharts TV for supporting and sponsoring this event, and for the incredible production services at that great team at StockCharts, and then also to IFTA, the International Federation of Technical Analysts, and all the great societies that make up that tremendous organization. Check it out, ifta.org. And with that, Martin, thank you so much for continuing this tradition in 2022.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.